lot of you who attend today's meeting, I don't know if you noticed that Warren Buffett started it with a statement. This is going to be a fantastic meeting. It's probably one of the best. Almost like he pre-announced his decision, right? He hold that until the end. So today, I'm sure a lot of you have learned a great deal from him. He touched upon so many topics, including macroeconomics, the trade. We all heard what he said. Trade should not be used as a weapon. We also heard him talk about currency, the government policy, the deficit, which is a very big problem we're facing right now. And certainly, as Euro, he shared a lot of ideas about how to invest in not only in the stock, but invest in yourself. So we'll start with some of the broader questions about what's our takeaway or highlights from today's conference. So I will start with Professor Kass.
Thank you. It is. Okay, well, certainly the big news of the day was at the very end, when virtually no one expected Warren Buffett to make the announcement that at the board meeting of Berkshire tomorrow, he will recommend to the board that after December 31st of this year, that Greg Abel will take over as CEO, and in effect, Warren Buffett stepped down. Now, he did not say anything about the position of chairman of the board, so I think one can assume that Warren will remain chairman beyond December 31st, and certainly he's CEO for the next 8 months of this year, so he's certainly not stepping down on Monday. He'll still be there, but the announcement, I think, came as a surprise to most people. I was a little less surprised in the sense that in his letter to shareholders 2 months ago, he sort of dropped a couple of hints that this could be coming. One, he said it won't be long before Greg Abel will be writing the letter to shareholders. And two, he mentioned sort of in the back of the letter that he now required a cane to walk, and which was new for him. So clearly mentioning that his physical health was beginning to decline, as one might expect for someone who's 94, and indeed he'll be 95 in August. But certainly that was the big news of the day coming out of the meeting. Now, other takes prior to this surprise announcement was Warren Buffett sort of, when being asked a question of what reaction did Berkshire have when the stock market had a very sharp decline in early April. And I think during 1 week in April, the S&P 500 dropped 19% or something like that. It was a very sharp decline, and there was maybe some panic among some investors. And it was very interesting. There's really a big lesson to be learned on how calm that Warren Buffett was when he responded. His response was, in effect, that was a fairly minor aberration. The market is quite volatile, and he mentioned 3 times in his career of 60 years of running Berkshire, that Berkshire stock dropped 50% each of 3 times, and clearly it didn't bother him at all. He had full confidence in the business. And so his calmness with respect to the recent market performance, I think, sent a signal. And he has said on many occasions, to succeed as an investor, the number one quality you need above some basic intelligence is temperament. That is not panicking when markets go down, not getting euphoric when markets go up. And I think that is a very valuable lesson for all, not only in investing, but even in our careers apart from investing as well. And then another point he made, a question came up, as everyone expected to come up. What are your view of tariffs and the current situation? And he made it quite clear that tariffs discourage trade. The whole world benefits from more trade. And so he had discussed some earlier recommendation he made around 2003, which no one followed. But certainly he expressed the negative sentiment that it was not really a very positive thing to proceed with restricting trade among nations. And then also, in response to a question, he said some very positive things about his investments in Japan with the 5 large Japanese trading companies. And he's looking forward, or on behalf of Berkshire, to increase Berkshire's investment, not only in those companies, but perhaps in other companies in Japan. So those were some of the highlights.
That's great.
It didn't surprise me a whole lot that Mr. Buffett made his announcement at the end. Like Dr. Kass alluded to, Mr. Buffett had already been discussing that in the future, Greg Abel would take on a larger and larger role, that he would be writing the annual letter. And even this week in CNBC, there were articles basically discussing the fact that Greg Abel has already transitioned to the day-to-day operations of many of the businesses of Berkshire Hathaway. So, we all have a finite life. And as much as we love and revere Warren Buffett, we know that someday that will end. I appreciate the fact that Warren approached it with his typical dignity, Midwestern sense of humor, and logic, because he knows much, like Charlie Munger's no longer with us. One day Warren will not be with us. He would rather set the table for Greg Abel to be able to take over the company and be able to succeed on terms that everybody understands. I think it would be difficult for all of us to wake up one day and find out that Warren had some sort of a medical issue and was forced to step down immediately. Instead, Warren gets to control the narrative. He gets to be able to turn it over to Greg in a very positive atmosphere and light. And so I think for all of us as followers of Buffett, again, it was another lesson in how to conduct yourself. For all of us as investors in Berkshire Hathaway, it's a wonderful reminder of how stable this business is and that Berkshire will be built to continue to produce very nice returns going forward. As far as the trade issues, I think it's instructive always to go back and look at history. Why did Germany and Japan get into World War II? Because they were struggling economically. And after the war was over, there were things like the Marshall Plan, which allowed Germany and Japan to have their economies heal and recover and develop in a capitalist manner. And that has brought us a lot of success in the world since World War II. And for the United States and for China to do well, we both need to benefit. China needs a thriving economy. The United States needs a thriving economy. One thing I have learned, this became obvious to me in the 1990s. My wife and I were traveling in Russia. And when you grow up in the time frame that I grew up, you were taught that Russians were not nice people. And then I went to Russia and I met Russians and I thought, they're really nice people. They're really hardworking. They're very industrious. And it causes you to take a step back and realize that our governments do one thing and the people represent something very different. And I think if you treat people with dignity and respect, you find that we are all very, very similar at the end of every day. We all want success. We all want happiness. We want safety and stability for our families. And I think that's something that's important to remember during this crossroads in U.S.-Chinese dynamics. We are all just wanting a better life for our families. And at the end of the day, our clients always like to ask us, you know, what do you think about the tariffs? What do you think about China? All I know is capitalism is the one thing that will deliver success for us and for China and allow all of us to live better lives. And I think that there's a wonderful lesson there in not using trade as a weapon. Instead, it needs to be a tool so that all of us live a better life.
That's great. I want to echo both of your comments. So number one, you know, the people. The people is always different than government. So I think our Secretary of Treasury, Bennett, recently said that the current tariff rate is not sustainable. What does that mean? It will come down, but probably nobody knows when. But eventually, the world is not going to work that way, right? So definitely want to echo that point. I think Warren made it super clear that you know, trade eventually make the world more prosperous, which is what's happening in the last 50 years or more. So, okay, so let's come to the next question. So both of you have followed Warren for so many years and followed his value investing principle. You teach at universities and you basically lead a firm, serve your clients. You probably apply those principles every day. I think one of the stories some of us may have read this the Wall Street Journal article that's probably 6-7 years ago. A lot of you know that Warren had 2 investment managers working for him and making a lot of decisions. So one of the investment managers, actually one of the things that really surprised him was he found out how much time Warren spent every day just read. He read newspaper, he read reports. You know, Berkshire has about 80 to 100 subsidiaries. If you think Warren does not read the report you submitted to him, that's wrong, because he not only read, he will be able to point out details in those reports. So then he's one of that, I think is Todd. He learned a great deal from Warren. He started reading most of the day. It's not something that a typical money manager would do during their typical day-to-day life. But Warren does that so differently than everybody. So the question is, in today's world that information is so transparent, now with AI, I'm sure a lot of you have asked that question, ask AI what stock you should invest. Probably a few weeks ago, you probably have asked that question, AI, what should I do now, right? So the question for you is, in today's world, which has changed a lot, right? Warren read everything himself. Today, you could ask AI to read for you and to summarize, right? So how do you apply those value investing principles in today's world? I'll start with Professor Kass.
Well, certainly there's more information available on the internet, on various media outlets, and information is more readily available to more investors almost instantaneously, making the investment climate a lot more competitive than it was before. And let me just add, not only is it Warren Buffett who reads 15 hours a day, but so do Ted Weschler and Todd Combs. All 3 of them spend 15 hours a day reading. Warren mentioned today at the meeting that there could be a variety of publications that have many pages in it, but very few people will read all of the pages. Very few will really understand what's going on. In fact, I think he said those who do read it won't spread the information, will keep it to themselves. In the current environment, when more information does become more readily available, it will indeed uh, pose a greater challenge. But Warren has said, if not this year's meeting, but in last year's meeting, that if he had to choose between the latest or the future, what's available from AI or one of his portfolio managers, he would take his portfolio manager. There is still human judgment that's involved, uh, and we don't know what AI will look like in 5 or 10 years. It may indeed replace many jobs that we currently have, and the competition being greater. But I think just those who look in the right places, for example, Warren saying not those who don't read every page. Yes, AI may indeed read every page, but there has to be some interpretation, some judgment involved. And I think there'll still be certainly a value added, if you want to say, from those who are working in the field, who are analysts in the field. And it won't be just plug into an AI model. Don't ask ChatGPT, for example, what stock should I buy today? But there will still be a demand for and an opportunity for individual analysis.
Our firm manages right at $2 billion in assets, and our investment team is sitting right over there. And I can tell you that we are starting to use AI in our investment process because it allows us to collate and collect tremendous amounts of information very quickly. So there's a software program called Delupa, which allows us to use Excel add-ins and to start harnessing them to go out into places where data is structured in a regular manner. So the filing of a 10Q or the filing of a 10K, we know pretty much where that data is going to be on a regular basis. It allows us then to use the technology of AI to be able to go out and start formulating that information in a manner that allows us to do at least preliminary analysis very quickly. And that allows our firm to operate more efficiently. That said, there are limitations to it. Again, we find that as of today, that data has to be in a structured manner and it has to be consistent. If the data is always moving around, you get a lot of ghosts in the data feedback from AI. It will creatively tell you things that are not there. And that requires, as Dr. Kass said, you've got to read that information yourself to make sure that you are properly interpreting it. But I also teach at a university, and I tell my students to play with ChatGPT as much as they possibly can. Figure out what it can do, figure out what it cannot do. Because it's really very funny in many aspects. It will give very unusual outcomes. And if you just rely on it to write your papers, professors will know very quickly whether or not you actually wrote that. They're very skilled at being able to see through what's going on. That doesn't mean that it won't continue to progress. So we are living in the world of ChatGPT for maybe 2.5 years now. That is an incredibly short amount of time. And it is already making a huge impact in the way a relatively small investment firm in rural South Texas can use that technology to compete with firms all around the world. So I find that aspect of it to be very interesting. In the classroom, it's kind of humorous, and I don't know Dr. Kass's stance on this, but there are some professors who are just scared of AI. And because they know that students can use it for the wrong reasons. In our program, it is a student-managed investment portfolio designed to teach kids how to break companies down in the same manner that Warren Buffett does. And then they have to use that to search out companies for inclusion in their investment portfolio. We've been doing this 15 or 16 years now, and it's worked really well. But that requires a lot of depth and analysis. You can't just say, ChatGPT, give me all the companies that Warren Buffett would buy today. You will not get a good response. There may be some reference to an article or some generalities, but it's not really going to help you. And as a result, you do have to be doing the reading and the thinking and the learning on a daily basis. I don't read nearly as much as Warren Buffett. I'm not able to read a fraction of what he does. But I will tell you on the technology side, I love being able to pull up research reports, and as I get older, my eyes aren't as good. I can't see 10-point font anymore. So I can put it on my computer in big font, which makes it easier for us to see it. And then I have the computer read it to me. And that gives me an additional way of absorbing information. Not only am I reading it, but I'm also hearing it at the same time. Do not deprive yourself of trying to shortcut the research process. You have to put in the time and the effort to truly know companies at a deeper level, and then be able to figure out why a company is a great investment. More importantly, why an investment will not work. If an investment is designed to do things that will produce long-term growth, that will speak for itself. But if it is over-leveraged, if it does not have a good business model, that is what you want to find out as early as possible. And AI can help in some of that, but at this point, we find that it's still in the very preliminary stages.
Thank you, Dave and Dave. Yeah, certainly very interesting. I think a lot of us probably use AI in various forms every day at work or personal life. One thing I think is clear you mentioned, AI results is actually highly inaccurate right now. Maybe one day we'll get there, but still nothing will replace, your personal reading. Those materials that we missed from the AI summary, they're so valuable. So, so with that, I would like to share a little bit of my experience as an Oriental trading company. We made acquisitions. After we're acquired by Berkshire Hathaway, we made a few acquisitions. One thing to our surprise is we didn't know actually Warren Buffett personally look at the acquisition and help us decide what the price is. So you would think he's making those multi-billion-dollar decisions that he would skip some of the smaller deals, but no, he's actually personally involved, and we actually learned a great deal from him. So we will touch upon another question in a little bit, but what happened is he will help us determine a price, right? So we have recommendations. He will give us his views. And, in different acquisitions, have different situations. In one of them, essentially, he thinks this is a no-brainer. Turn out 10 years later, it is a no-brainer, right? So it followed every value or principle he followed in making his other decisions. In that transaction, we actually did not get the deal first. But the banker went through everything else. Everybody else actually were out. Eventually, banker came back to us. So this is another principle that Warren and Charlie followed for so many years. So essentially, I think it applies to our personal investment in any stock. So sometimes you may feel that there's one stock you have to own, but the answer is absolutely not, because Warren and Charlie said that many, many times. There's not a single company you have to own, right? Opportunity going to represent themselves later. Maybe later you would own the company, maybe you will never own this company. But that's fine. There are plenty of opportunities out there, whether you acquire a business or you buy a stock. Never say, okay, I have to own this company. So thank you so much on that. So let's go to the next question. So both of you touched upon a little bit the recent uncertainties. I think that's the word that volatility, uncertainty has been used so many times. I think early April, the drop in the stock market probably scared a lot of people. I often joke around a little bit, say, I have actually a friend who did very well investing, but he told me that during the financial crisis, he said that he couldn't sleep for multiple nights because of how far the stock dropped every day. So I joked with him, say, okay, if you can sleep well, just like another day, when the stock market dropped 5%, you're good, because those temporary drops does not affect you. It does not affect how you invest, right? So certainly losing money is painful, but I think as an investor, as a more mature investor, you're gonna look at the longer term. I think Warren said a few times today that the recent market volatility is nothing, right? It's nothing. So if you think you agree with him, it's nothing, then you're gonna take a longer view. So from that, I wanted you guys to kind of go a little bit deeper on regarding the recent uncertainty and looking forward. I think the uncertainty is not going away. Even the market has come back to like 2 months ago, but the uncertainty for the next 6 months, maybe even a year, is not going away. So what are some of the factors and things you're going to look at when you think about how to invest, not only for the next 6 months, but also a year or longer? I mean, longer term, Warren said, market is going to go up, right? I think you think about today, you put money in there, 5 years, 10 years from now, it will go up. There's no question about that. But I think a lot of us also want to think about near term, 6 months to a year.
Well, it'll be very helpful to look at some of the actual numbers of the stock market behavior over time. If one looks at the S&P 500, for example, and you go back 100 years, the compounded average annual rate of return has been about 10%. 10% a year, that's pretty good. That means using the rule of 72, your money would double every 7 years. Looking at the numbers a little more carefully, as I did recently, over the last 80 years, the S&P 500, with dividends reinvested, or dividends included, has gone up 80% of the time over the last 80 years. Basically, what Warren Buffett is saying, and these are some numbers just backing up his reasoning, is that the market will grow. Our GDP will grow. Our GDP in this country growing between 2% and 3% a year. That is very likely to continue. We do go through some rough patches. I've been following markets for decades, and there's only been 3 time periods that I became really concerned and worried. And I know the first 2 at least, so was Warren. The first one that I'm referring to is the Great Recession, 2008, 2009. And that market pretty much hit a bottom in March of 2009. And that morning, when the market hit a bottom, Warren Buffett was actually being interviewed on CNBC that morning. And I noticed that he was uncharacteristically looking a little nervous. Even though he didn't reveal it, he clearly looked it. And subsequently, mentioned, I had the privilege on several occasions of being able to bring students to Omaha for private meetings with Warren Buffett. And questions would come up on the financial crisis. And Warren Buffett basically said we came very, very close to disaster at that time if Congress didn't put up the $750 billion into the banking system. At that time, the Treasury Department and Federal Reserve didn't do the right things at the right time. We could very, very well have been in another Great Depression, but we did the right thing. That did occur. During the pandemic of 5 years ago, Warren Buffett was also very nervous. We have one pandemic every 100 years throughout history, the last one being 1918, the Spanish flu. And it was unclear how long it would take us to recover. Fortunately, we had modern technology. People had computers at home. We could work remotely, which helped us get through it. And of course, the development of the vaccine helped. He was very nervous at that time and was not investing. And he did bail out a lot of companies in the Great Recession. Goldman Sachs, for example, took a big loan from him. In 2011, a big investment in Bank of America. This time is the third time that I myself have some concern, but Warren today made it quite clear he did not. And I found it personally very reassuring that he didn't seem to be particularly bothered with the economic environment changing a fair amount in the last few months, and arguing or mentioning that our economic environment always changes over time. Look how different the country looks today versus 250 years ago, where agricultural society and how much we've grown. So just looking back at history, yes, there are risks. There could be high volatility. Markets could drop 30%, 35% in 1 year, or Berkshire could drop 50%. But with capitalism, with our system, the right thing to do from his point of view, opportunities will occur, is pretty much stay invested, have a long time horizon. And I'll define a long time horizon of at least 5 to 10 years. And if one looks out at least 5 to 10 years, ignore the bumps on the road along the way, and I think we would do just fine.
Thank you, Dr. Kass. I agree. I hope every one of us listened to Warren when he talked today about cathedrals and casinos. A cathedral is something that is beautiful, something that is to be protected, something that it is to be revered and respected for very long time frames. A casino is there to take your money. When we talk to our clients and we try to formulate an understanding of how to go about investing, we quote Warren Buffett word for word. Is it predictable? And is it consistent? If it is predictable and consistent, then do you truly understand it? If it's predictable and consistent and you understand it, then that really narrows down the world of investments that you should ever consider. When looking at investments, do me a favor, do yourself a favor. Never call it a stock again. A stock is a ticker symbol that blips up or down. The casino wants you to focus on nothing but ticker symbols. But just like Oriental Trading Company is a wholly owned business, it does not get a ticker symbol telling us if it's a good day or a bad day. Instead, I'm guessing that every employee at Oriental Trading is focused on getting the best products, giving good customer service at a fair price. And if they do that over a long time frame, great things happen. Every one of us needs to think about our investments as businesses that we are going to hold for a very long time frame. So statistically, we will tell our clients that if they're going to give us money, They need to have an appropriate time frame, which models out very similarly to what Dr. Kass said. The stock market, if you go back over the last 70 years, has gone up as much as 56% in 1 year. It's also dropped as much as 37% in 1 year. That means that if we're an investor for 1 year, we're either really, really happy or our life is really bad. So why would you even want to play that game? Do not play that game. You do not have to play that game. If you are a business owner, you are going to ask questions about what were my sales? What were my earnings? What was my cash flow? What is my debt level? What is my return on equity? What is my return on capital? If those things are all moving in the right direction, you turn off the news and you focus on business fundamentals. It allows you to sleep well at night. It allows you to focus on where you want to be in 3 to 5, but preferably 5 to 10 years. If you do that, and CNBC is telling us that there's breaking news and something bad is happening in the world, which is like every 5 minutes, if you get pulled into that, you will make bad investment decisions. But if you focus on owning quality, predictable, consistent businesses with very high returns on equity and return on capital and low levels of debt, you will sleep well at night and you will become great investors all in your own right. It is about having the appropriate time frame for great businesses. If you own great businesses, but you trade them on a daily basis, you are going to be guaranteed of giving money unnecessarily to the casino. The casino is not there to tell you good investment, bad investment. The casino is there to tell you on any given day, at any given moment, I will give you cash for your asset, and this is the price. If you do not need liquidity, if you do not need cash at a moment's notice, then you should not even be listening to them. It's distracting. You need to focus on the financial statements. Today, Warren talked about the balance sheet. That's where all the quality characteristics of an asset are. If the characteristics of a balance sheet are good, it allows you to be very patient, and you know that long-term good things will happen. That is how good investors become great investors and build wonderful fortunes over long time frames. The casino, meaning the stock market, is there to give us immediate liquidity. If you don't need liquidity because you are a long-term business owner, stop worrying about short-term things. The way you win the game is to have the appropriate time frame and then focus on predictable and consistent businesses.
Great. Thank you, Dave. And Dave, certainly great insights. I'm sure I really like your last comment regarding watching CNBC or whatever, right? So I'm sure a lot of you may have followed stock commentators, experts everywhere. If you really pay attention to what CNBC was doing, they're always this opposite opinion. They would always invest someone who would say this, and another person would say the other side of the story. So because they're not going to take any risk, but they want to give you information. But if as a person, as a personal investor, if you are influenced by one side of the story more than the other side of the story, you're going to make a decision based on what they say. I think when stock market dropped, there are people going to say it's scary. They're concerned. Are we going back to 1929? If you get scared by that comment, likely you're going to make a wrong decision. But so it's like a lot of psychology in the personal investment. The game catch almost everybody all the time. Interestingly, I was thinking about what happened in the last month or so. If you just recently got into the stock market, I think you look at what your stock statement or the portfolio list, I'm sure some of you may have seen on the entire list, certainly everybody here is a Berkshire Hathaway investor. I think the only stock on there, which is a green so far, certainly green in US, it means stock went up. In China, it means stock went down. But either way, for a lot of us, the only stock on that list that's actually grown this year is Warren Buffett's, is a Berkshire Hathaway. So that come back to what both Dave just said. Owning a stock, just treat it as owning a company. You ask yourself, did this company change in the last month? Or did their business model get changed or disrupted? If your answer is no, you're owning exactly the same company as you owned a year ago, 2 years ago. So if you know you owned a great company, nothing has changed. That's why I take a longer term view, and I think all of us going to be benefited from that. So another question I would like to touch upon is, there was a question today regarding the patience and the speed of decision making. So Warren has said many times that the investment opportunities is unlikely to be found tomorrow, but it will be very likely to be found in 5 years. So, which I kind of mentioned a little bit ago, Warren and Charlie never regretted missing, I won't say regret, never afraid of missing any transactions. There are plenty of opportunity to invest, but you're gonna know the time is right, the opportunity is right, and the valuation is right. So you never feel bad about missing a deal when something isn't working, right? So coming back to, is it discipline? You have to follow all the disciplines. You're gonna tell yourself, this is a great company, but the valuation is not there. I'm not going to invest. I'm gonna pass this time. So he talked a lot about the patience and decision-making. When he sees a great value, he will make a decision quickly, right? So there are many, many examples, including our company who was acquired by Warren Buffett in a very, very short manner. He actually did his own due diligence with some of our customers, personally calling friends who are our customers. Ask them, how do you tell me about a company? So another example is, I think, David, you led your student groups to Omaha to meet with Warren. That's probably 10 years ago, 8 years ago. One of the student groups, I think it came from University of Tennessee or one of them. The student group actually came up with a proposal to Warren in that meeting. That's the Clayton home, right? So Warren had never heard of this company. So the student presented such a convincing kind of a proposal regarding who this company is and what they do. It led to this is all public information, you can find it. So it led to a conversation between Warren and the owner of the Clayton homes, and a transaction happened very, very quickly without external knowledge, and it was announced. So you see those fabricated home in the exhibition hall, how nice the home is. So that's when he said, yeah, decision making, when the value is right, he will make decision very quickly. He does not use institutions, like a lot of the large transactions are managed through investment banks. Warren Buffett never used a single investment bank in his entire life, no matter the size of the deals. So I wanted both of you to talk about patience. It's not only about decision making on buying a company, investing in stock applies too. It's the same thing, and also decision making. How to make the best decisions.
Okay, thinking of a couple of examples of being able to make a very quick decision, short period of time with limited information. I think it was maybe 15 years ago, 10, 15 years ago, Warren Buffett receives a 2-page letter from the CEO, the owner of a private company in Israel called Iskar, a machine tool manufacturer, offering to sell his company to Berkshire. And one advantage of selling a company to Berkshire is not only does it permit the owner to basically monetize his holdings, but he could remain in place running the business. And based on the 2-page letter, Warren invited the writer to visit his office, and almost immediately they came to a $5 billion deal, I think to purchase 80%, which later became 100%. Warren would not hesitate. Precision cast parts. That was a very interesting example there. That's actually one of the cases that I teach in my class. Actually, I co-authored a case with one of my colleagues, a corporate finance case on precision cast parts. Here, the CEO was visiting Berkshire Hathaway. Todd Combs, at the time, had made a fairly sizable investment on behalf of Berkshire in precision cast parts. And the CEO had come by and was chatting with Todd Combs in Berkshire's office. Warren comes by, listens to the conversation, sits down, and then within a day or two basically makes an offer for the company, and which he did acquire in January of 2016. So Warren can both act very quickly and be patient. He's sitting on $340 billion of cash. It's not burning a hole in his pocket, even though he would prefer to see it invested either in whole businesses or pieces of businesses, as he describes stocks. He'll wait for that opportunity to come along. What he referred to today, when he mentioned today, the next big opportunity may not come for 5 or 10 years, maybe he's thinking then possibly there could be a recession, a severe recession at that time, which generally would indeed drive down stock prices, which could create very good opportunities for Warren and Berkshire to invest at that time. So he's patient, waiting for the opportunity, and when it occurs, he can act very quickly, far more quickly than a private equity firm or other possible competitors who may be interested in making that same purchase.
You know, the dynamic of patience is pretty much the counter opposite of the way Wall Street operates. And again, it is a game, and they are tempting you and trying to pull you in. If I had to give all of you advice, it would be to sit and read and study businesses that you can understand for the next year. And at the end of 1 year, invest in one company, the single best company you think you can understand, that is predictable and consistent, that you think you can buy at a fair price. It will force you to, number one, read every day to try and gain that level of knowledge. The problem is that our phones and trading systems have made things so easy. Now we have commission-free trading, and we can just get out our phone. My students get in trouble for trading in the middle of class. All the other professors are mad at me because my students are busy buying and selling in the middle of class. Don't be that person, because you will make mistakes. So again, read and then do a forced rank. The program I teach, my students 3 times a semester, so once a month, they have to research a company that is predictable, consistent, that they understand, low levels of leverage, and they have to narrow it down to their single best idea. We run a concentrated portfolio because that's where you will get better results. But you can only get a concentrated portfolio with good results if you have done the reading and the research first. and then you have to wait for that opportunity to come along. So if I were giving you advice about patience, it would be to read for the next year, and at the end of 1 year, invest in the single best company, and the next quarter, invest in the best company that you can find. That's just on patience. As far as all these other things that are going on, you can get pulled in a variety of different ways that will really make your life difficult, but you are in control of your life. Again, going back to the CNBCs of the world, what business do you think CNBC is in? Most of us will all answer that they're in the financial news business. That is absolutely wrong. They're in the advertising business. And the more breaking news that they've got, the more eyeballs tune in, the more that you are exposed to ads, the more ads that are viewed, the more money CNBC makes. It is a game. We have 7 TVs in our office. 6 of them are turned off at all times. 1 of them is turned on, but it's on mute. We will only listen to CNBC up until 8 o'clock in the morning, Central Standard Time. Once trading starts, we turn off all of that because it's distracting and it takes us away from focusing on the process. So do yourselves a favor, hold them at arm's length. You control your calendar. You control what you read. You control what you research. Do not allow people into your world unnecessarily, especially people that want to sell you something. If they want to sell you something, follow the money and you will see their motivations. Maybe it is in your best interest, but quite often it is not. So if you hold them at arm's length, you will protect yourself, you'll protect your finances, and you'll do a better job. In terms of another aspect of patience and how to be a better business person and investor, we see more businesses get in trouble by growing too quickly. They die by digestion, trying to gobble up huge market cap, trying to have huge sales. Give me a business that can grow logically and consistently, will do much better. Going back to the discussion on the balance sheet, we spend tremendous time looking at the debt structure, and not just debt. We look at leases and formulate out that that is really a quasi form of debt. We look at preferred stock. Even though it's called stock, it's not. It's a form of debt. We look at things like pension shortfall. If you have $100 million of missing money in your pension, that is an obligation to the company. We want to know all of the obligations such that the next time there's a big market correction, we want to know, can our portfolio of companies, can they self-fund the needs to service their debts, or are they going to be reliant on the kindness of strangers? That is a Warren Buffett quote that was alluded to earlier today by Greg Abel. Greg said when he had his vision for the future of Berkshire that he never wanted to have to rely on other people for the success of Berkshire. Basically, he meant, I don't want to put us in a position to where we are so leveraged that we're constantly having to go out to bankers to say, please lend us money, please lend us money. In the great financial crisis, it wasn't just Goldman Sachs. It was Dow Chemical. It was Harley Davidson. It was General Electric. It was Tiffany. I mean, there were like 8 major companies that came to Warren Buffett on a Friday afternoon and said, if you do not lend us money today, we will not be able to open for business on Monday. If you want to see a tidal wave of really bad things happen in the world, you have those 8 companies all file for bankruptcy or insolvency. But Warren, because he had been patient, he had been reading for decades about those businesses. He was then in that position to be able to say, not only can I help save the economy and probably prevent the world economy from melting down, but I have the cash because I manage my affairs prudently. I can step in I can take an investment in all these businesses. I can stabilize them. I can do well for Berkshire shareholders, and I can help the world economy. That only comes along probably once in our lifetimes. And if you are not prepared by doing your research and reading day in and day out, when the opportunity does come, you'll be too frightened to act. So that is what you are doing. You're training your brain to look for opportunities. They do not come along very often. So going back to where I started this, read every single day and don't make a single decision for a year. If you do that, you'll be a lot more patient. The worst thing you can do is to get new money and immediately go and buy an entire portfolio of 50 names. You will make bad decisions. Don't do that.
Great. Thank you, Dave and Dave. So if I could summarize, information, watching CNBC, take the information, don't take it, the emotion, right? Form own opinion, do research on companies. Actually, I think Warren Buffett also, between last 5 to 10 years, he also offered an approach to all of the retail investors, which is to invest in S&P 500 ETF. If you do that, you don't have to read every day. If you don't like to read, invest in SPY or VOO, you probably sleep good every night, and you can do other things you like to do, and you're going to beat 90% of the fund managers, which is a great investment. Without doing much, you're actually doing really, really well. So I just want to use that to wrap up. Thank you so much for sharing your experience and the insights today. I'm sure we all learned a lot. Okay. I think, yeah, thank you.
So the question is, what is your view on the crypto market in the next few years?
The concept of cryptocurrency, and I know that this talk tonight is partially crypto and gold related. I can understand gold much better than I can crypto. Crypto, if all the central banks around the world were to manage their affairs properly, I don't think crypto ever would have come into existence. Crypto is a reaction against fiat governments printing money and devaluing their currency. So people are mad. They want a different currency or methodology for trading value that goes outside of it. The limitations are, though, I don't know who stands behind crypto. I don't know what the audit process for crypto is. And crypto does not trade like a currency. It trades like a commodity, which makes it very difficult for me to conceptualize. And as a result, we just can't get our mind around it. We recognize why people are doing it. I don't blame them for feeling the way they do, but it doesn't mean that I have to do it. It might be perfectly appropriate for other people who know a lot more than I do.